Hey, Dave Buzanko here for Heartfit365. And today we're going to be reviewing The Wealthy Barber, one of my favorite financial planning books of all time. I think this book is an awesome book. It was written by the author David Chilton, and I know that there's a more recent version called The Wealthy Barber Returns, and I think that's going to be based more on today's investment vehicles that are available to us with the digital economy. But I want to talk about this book in particular because this is a book that my wife bought for me 27 years ago, bought back in 1991. And I've since had an opportunity to meet and talk to David Chilton. I think the book was fabulous. I think what he wrote down here is essential information. Regardless of how the stock market performs, it's basic financial knowledge that I think every family should possess. So one of the key points that the book starts off with is just, first of all, the book isn't written in a dry context. It's written in a story format. It's written in a story where it's some siblings who are in their 20s just sort of getting started out with their families and their careers, and they find the most unlikely candidate in their hometown, the barber, who became their mentor for financial guidance. And it's really important to think about, who we have in our lives as mentors for financial guidance. Are we surrounding ourselves with people who are financially illiterate, or do we actually surround ourselves with people who actually are successful financially and sort of taking the advice that they're giving and molding our own behaviors on that advice? So some of the cool things about this book, I won't go through all of the strategies that David mentions, but I think there's some important ones to point out. The first strategy, or the first point that David mentions, is that across North America, probably around the globe, the majority of us are financially illiterate. We have a very low financial IQ. That's a problem because unless you understand what to do with the money that comes into your home on a monthly basis, you won't understand how to have money work for you, which is a big key to becoming financially independent as you grow older. But one of the fun things about this book is it talks about some investing strategies. And what I thought would be fun is to look at the three various strategies that the book talks about and look at what would have happened if I had followed certain strategies over a course of 30 years. So there's three basic financial strategies that you can follow. One is you can create businesses that create passive income for you. You can buy real estate that creates passive income for you, or you can invest in financial stocks or mutual funds that can create some passive income for you. The key is to create or invest your money in a way that it will create passive income for you for the rest of your life. That's the goal. But it's kind of interesting because I followed two of those strategies. One that I didn't follow a lot was investing in the stock market because I just had this very low level of confidence of mutual fund investors. And I cut my teeth, well, about 27 years ago, getting my mutual fund and insurance brokerage license. And I've got a bit of a base knowledge of how these things sort of work, and I don't really have a strong confidence in those market managers, those money managers. So I thought I would go the route of trying to build businesses that create passive income and buying real estate that creates passive income. But from a financial standpoint, if you do your homework, and the key here that Dave is trying to make is we are a financially illiterate country and we need to improve our financial literacy. So the first big key here is that it's on all of us to get a basic foundation of financial literacy. Be able to look at the money coming into your household, the money going out, and look at where you're being charged interest, and look and say, hey, am I living within my means, and am I actually being able to scrape the money together so that I can actually save 10% at the end of the month and either invest that in mutual funds, invest that in real estate, or invest that in a business opportunity. You have to do your homework to decide which one of those different vehicles is going to perform for you. But what I thought would be kind of fun is because I got this book, 27 years ago, I thought it would be fun to sort of take the last 30 years of stock markets and look at what the average rate of return has been and look to see what would have happened if I had followed the advice in this book. So if I had saved 10% of what I brought home, so let's just say for the last 30 years, I've made $50,000 a year. And let's say that after taxes, I'm bringing home $3,900 or $39,000 a year. That means annually I have $3,900 if I'm saving 10%, if I'm investing 10% to invest. So I've got $3,900 to invest, that's 10% every year into something that will compound for 30 years and hopefully give me this big return. Well, at the time that this book was published, and quite often in financial terms, in the financial markets, they always said, oh, you got to take averages, and the average always works out to about 15% return if you play the long-term game. Well, over the last 30 years, the actual numbers have been, if you were to invest into just mutual funds, the average rate of return over the last 30 years has been 3.6%, and the S&P 500 has been 6.73%. So, again, if you're really good at picking stocks, you could have done really, really well in the stock market. There was a dot-com boom and bust. There always are all kinds of opportunities to make money on stocks. But clearly, if you're going to use a money manager and use mutual funds or buy into the index, you're using other people are managing those decisions for you, and their averages are what you want to pay attention to. So looking at that, if I had invested that $3,900 annually for the past 30 years at 6.7%, which is reality, that's what actually happened, I would have ended up with $350,000 in the bank. But by the book where they talk about 15% return, that would have been $1.7 million. So you can see there's a dramatic difference between, say, $350,000 and $1.7 million, and that is the difference in the compound interest. So, and the rate of return. So on that part of the book, I kind of go, you know what, it's tough to predict futures. It's good advice in theory, but I think clearly if anybody's been invested in the real estate market in the last 10, 20, 30 years, you'll notice that your real estate has appreciated much more than 6.7%. So real estate might have been a good investment back then, and depending on what you're buying today, might also be a good investment. I also love investing in businesses because businesses have the opportunity, especially online businesses, have the opportunity to create passive income back to you. And well, that's another discussion that we'll have in another video, because I think there's a lot of great discussion to have around people trying to create passive incomes online. And there's some truths, there's some myths, there's some pitfalls, and we'll get into that in the future. But one of the great things about this book is that it's written in a story format, like I'd mentioned, so it makes it easy for somebody who's not financially literate to read the book, understand what's going on. And one of the key things this book helped me do was to go out and get a will made. So it sort of forced me as I was going along in the book. It said, don't go any farther until you go get a will made. I will not talk to you again unless you get a will made. So I actually went out and got a will made for my wife and I. And we've had it, I don't think we've updated it in probably 25, 26, 27 years. But I've got a will, and if I were to die tomorrow without a will, the government takes a lot of your funds. So it's absolutely imperative that you have both a living will and a will for the eventual outcome that will happen to all of us. So actually understanding how to put your finances together and have them organized in a way that if something unfortunate should happen, that those around you don't have to suffer more than they already are going to suffer probably. So that was kind of an important message, that it was an idea we're sharing, that we should all have a will. We should all have a living will. And what are the differences between the two, and where can you get those wills from? Something else that David taught me was about financial investing and about buying low, selling high, and something called dollar cost averaging. So I really love the theory of dollar cost averaging, which simply means that every month you're going to do something called forced savings. You're going to take that 10% off your paycheck. You're not even going to think about it. It automatically comes out of your bank account every month, goes into a forced savings vehicle, and you get to take advantage of what we call dollar cost averaging, meaning that if that, say, 10% every month was going into a mutual fund, well, the fund goes up and down, and over time, it averages out to a certain number. So the idea is when the stocks are high, you're not buying very much of it, and when the stocks are low, you're buying more of it. You're getting the advantage of the highs and the lows, and it's done sort of automatically for you. But it's the idea of dollar cost averaging. It's the idea of forced savings, about investing almost unconsciously and just setting it up and letting it run. I often use that analogy with wellness and fitness because it's sort of the same thing. If you just invest in yourself every day 10% of your time, over time wonderful things happen. It's that dollar cost averaging, it's that compounding interest. So I think there's a lot of similarities between finance and health and wellness, and you'll hear me talk a lot about those things. So of the three choices that Dave offers as far as an investment vehicle goes, one was mutual funds, one was the stock market, and one was real estate. Whatever one of those investment vehicles you choose to follow, I think the idea, first of all, is just to have a plan. Become financially literate, have a plan for yourself and try to leverage the money that you bring home as your investment money, right? Your homework really should be, what do you do with the money you bring home? Are you giving it away? Are you spending it frivolously? Are you budgeting well? Are you able to save 10%? You know, these are the sort of questions you have to ask yourself so that you become financially literate, so that you can start to create some wealth by having passive income working for you. Now, one of the things Dave goes on to talk about is RRSPs. In Canada, they're registered retirement savings plans. In the States, I think they're 401ks. But they're investment vehicles that the government puts together for you so that you can save your money in a protected vehicle, and then when you retire, you can draw on that income to at a lower tax rate than you would have otherwise paid as you were in your working years. But there's something really interesting there, and I want you to think about this because it's always sort of bugged me about financial planning in the stock market. And that is, if you were to take, let's say you had $1 million today in the bank. Now you had made that money through investment planning and you were going to retire. So you got $1 million in the bank and you're going to retire. Let's say you decided to, the market was performing at 6.7% and it was going to pay you out annually. If you don't touch the principal, but you take the interest and live off that now, it's retirement time, it's going to pay you a dividend of about $6,700 annually. Well, what would it take if you were to do your homework and create passive income either through real estate or through an online business that was making money for you? Well, you'd actually only have to create passive income streams of $1,300 a week to match $1 million in the bank, because the interest that you would receive from $1 million a bank based on $6,700 or $67,000 a year would only be $1,300 a week. So the way I look at investing and the way I look at business is I look and I think, hey, the riddle here is, how do I create passive income of $1,300 a week? And if I can create passive income of $1,300 a week and I keep doubling that duplicative model, every time I duplicate that, that's another $1 million typically in the bank. I mean, that's the same as having $1 million in the bank. You don't have the equity of the asset, but as a business owner, you have the equity of the asset that's creating the passive income for you. And so it's an interesting context and one that we'll explore further. One of my other favorite book series, you may have guessed this, is the Rich Dad book series. So I started off with Rich Dad, Poor Dad, got into the cash flow quadrant, then got into increasing your financial IQ, then got into Guide to Investing, and then I bought Rich Dad, Poor Dad for my kids. And I thought that was really cool because my son was probably 7 or 8 years old and we were canoeing in Algonquin Park. He was up in the bow of the boat and we're canoeing away. And you know, as a father, you talk to your kids about things, you ramble on, you think some of it might sink in. And we're paddling away and all of a sudden out of nowhere, this is a 7-year-old boy, he turns around and says, "Dad, I know we're supposed to have our money working for us, but," and then he asked a question. And I was blown away because he actually was listening to what I was saying and he was actually stringing together a thought that was an intelligent financial question. And from that conversation, we ended up going out and taking some of his savings that was in the bank and we bought him a gumball machine. And that gumball machine became an income-bearing asset. We actually had a place to put the gumball machine. It was a local humane society. I called them beforehand and said, "Hey, would you like us to bring a gumball machine in? We'll maintain it. And we'll split the profits with you." So my son had a gumball machine. He paid, I think, $250 for it. He put gumballs into it. We brought it over to the Humane Society. We were charging $0.25 per gumball. And every month we'd go in and we would fill up the gumball machine and take out the money and split the proceeds with the Humane Society. And he was making about $30 a month off this gumball machine after he split the profits with the Humane Society. So after about 3 months, the Humane Society decided that they caught wise to this and went, "Hey, we'll just buy the gumball machine from you." But I thought it was a really good lesson for my son because not only did he retain the asset, right? He spent $250, but now he was making $30 a month interest on that $250, and it was really costing him very little of his time to go and count out the quarters and divvy the money up and top up the gumball machine again. But every time I look at creating an asset online or creating another company, those companies are always a type of company that's going to be creating passive income for me. So I look at every time I create a YouTube video, and you know, the way, if you're not aware of it now, by now, The way that YouTubers generally create passive income is all those commercials that you might be clicking through. Well, if you just let that commercial sit there, the YouTube creator gets to leave content for you for free. We get to share with you our expertise for free. And if you allow that commercial to play beforehand or allow the banner ad to be displayed, we get a very, very small fraction, but those pennies add up. And every single video that I put onto YouTube, or any YouTube creator puts onto YouTube, that's like a little gumball machine. And over time, if you had 1,000 little gumball machines lined up and people were finding that gumball really interesting, over time you start to create some passive income from those little investments. So, I think the idea of creating businesses and creating wealth, that to me is a lot more appealing than just sort of handing my money over to a money manager and letting them do what they're going to do with it. I do have, from Dave's advice, I do have some RRSPs. My wife has some RRSPs. We've invested in real estate and we've invested in businesses. So we're sort of diversified in 3 different things. But back to Dave's book, because I sort of digressed there. First of all, I think that one of the key concepts that Dave talks about is creating a budget and learning how to live within it. That is huge because too many of us today just, we leverage ourselves on credit. We take vacations because we think we deserve them, when in reality, yes, we probably could use a vacation, but we haven't been doing our homework at home with our finances to be able to pay for that vacation up front. I can tell you over the last 30 years, the best vacations I ever took were the ones that were paid for before I left. That made the whole vacation enjoyable. There was no stress, and I really got to enjoy myself. There's nothing worse than coming home from a vacation to a Visa or MasterCard bill that shows that you overspent, and now you've got to save for the vacation you had a couple of months ago to pay down that debt before you can start saving for the next vacation you want to take. So again, tough one, but live within your means. All in all, I'm going to say that this book right now, based as it is from 30 years old, is still a good 3 out of 5 Heartfit hearts. That's my ranking system. And I say that because there's still some really great advice that applies here. The idea of living within a budget, the idea of saving 10% and investing 10% annually. But I think today we need to look a little more closely at what all the different investment vehicles are for us. And really it's on each of us to go back and look at those different investment vehicles and improve our financial literacy. So if this book does anything for you, if you pick this book up at a used bookstore and you get the original copy like I have here, take the book, get the book, read the book. It's a fun read, it's a good read, and it's going to give you the basic financial tools, the foundation you need to move forward. I would suggest that if you really enjoyed the book, that you pick up Dave's The Wealthy Barber Returns. Those of you who don't know Dave Chilton, he was one of the Dragons on Dragons Den on CBC in Canada. So, I mean, David has made a good wealth for himself, not only creating a business. See, at the beginning of the book here, he talks about his business is providing employee-sponsored seminars. So Dave went around and did sponsored seminars that were paid for by the organization, came in, taught their employees to be financially literate, and they all got a copy of this book at the end of the day. So Dave had a vehicle, a business that was creating money for him, but he was also then taking that money that he made and investing it either in real estate or in financial, on the open stock market or with mutual funds. But I think the bottom line here is this is good financial wisdom for those of us just getting started as to how the stock market actually works. And then I think when you get into a book kind of like Rich Dad, Poor Dad here, I'm going to do a book review on this book because I think this one again is written very much in a story format. But I think the Rich Dad, Poor Dad series goes into a little more deeply the mindset of the rich and how the laws of finance have been made by the rich for the rich. And I've seen that in my own personal life with my own professional accountants and looking at how the tax laws really are designed to help people who have money keep money, and for those who don't, to keep paying into businesses created by those who have money. So a bit of a cynical view there, but I think the idea is we all need to, as Robert Kiyosaki says, improve our financial IQ. So at the end of the day, The Wealthy Barber, awesome book, good read, great financial foundation. Get the updated copy. Make sure that you are on top of all the current trends in financial investing. And by no means am I a financial planner or am I offering you financial advice. I'm simply telling you that this is a good book to read. It will give you the basic foundation that you need for investing in your financial future, and it will give you that starting point to having the financial IQ that we all should have and need. So if you have any comments or questions, please feel free to leave them below in the links below. That's how we keep the conversation moving forward. If there are any books that you'd like me to review, I'd be happy to do so. Please, again, just leave those comments down below. If you agree with my comments or would like to share this information, please feel free to like, share, and share the video with your friends. Our job here at Heartfit365 is to provide you with financial, physical, and mental wellness solutions that are going to help you lead a very happy and healthy life. So thank you very much, and I look forward to seeing you in my next video.